Hi, good evening, good morning for some of you, and good night if you're joining from various time zones in the world. Welcome to INSEAD Tech Talk today. My name is Ben Charoenwong. I am an associate professor of finance here at INSEAD, and I'll be hosting the session today. So today's webinar is part of the TED Talk X series by Digital at INSEAD. The entire series is dedicated to exploring new digital technologies, their applications, as well as their impact on management, business, and society. No doubt you've seen some of the upcoming schedule that we have ahead, things related to AI, hiring trends, and so on. If you'd like more information on the series, please visit the Digital at INSEAD website. And also, I'd like to thank the sponsor of this TED Talk Tech Talk X series, Accenture. And before we just dive into the topic today, let's do a little bit of housekeeping. So the audience is muted. The video and chat functions are disabled. So if you have questions, please use the Q&A tab. Rajeev and I, as well as Sandra, is helping out, can also see all of the questions. Please keep the questions short and to the point if possible. And to help us identify the most relevant questions, you can also upvote on some of the existing questions other people have asked. And of course, the webinar is being recorded and will be published on YouTube afterwards. If you have any technical issues, please email digital@insead.edu. Great. So let's get started. Today with me, we have Rajeev Tummula, who is the head of digital and data for Asia and MENA at HSBC Securities Services. He spent the past 7 years with HSBC, and before that spent a good decade at Bank of America in the tech and ops space. So he's a deep expert in this field with about 2 decades of experience. And I think he's exactly the right person to talk to when thinking about how is the new innovation in regulatory technology going to impact business operations, financial services, and so on. Okay. So before we get started with the conversation with Rajeev, let me just kind of give this broad overview of where we are in terms of RegTech and why I think it's interesting. I think to most people, regulation seems so lame. It's a little boring. Um, and some people delegate that as a back office job. But let me try to convince you, based on some of the research I have done in this space, that actually there's a lot of potential impact on business practices as well. So just to give you some background, let me quickly run a poll and just ask, today's topic is a bit of a niche topic, but we're still quite interested in wondering where you think RegTech can be used. And so we'd like to ask you a poll question. When we're thinking about in your firm, how is regulatory technology used? So whether or not you're in financial services, right, the burden of compliance has risen over the past several years. And we're quite interested in thinking about, what does that technology have to do with the rest of the business, right? Whether it lives in its own, little segment, right? Only used in risk and compliance, or actually that like feeds in information to management that it can actually help management make better investment or capital allocation decisions. Okay, so the questions are asking you, is it important? Absolutely critical, only used in risk and compliance, occasionally used outside of risk and compliance, or, used in other areas, kind of not that relevant for management. Okay, so I could see the answers are quite interesting. Okay, so with this, I think we have like a good chunk of the attendees already answering the poll. But I'm quite surprised because what I'm going to show you is actually the results from a global survey run by Thomson Reuters. And for those of you who may not be aware, Thomson Reuters used to have a huge data analytics business. In addition to that, they have a risk and compliance advisory business. They sold the data business to London Stock Exchange Group, but they kept the compliance and regulatory consulting arm. So that Thomson Reuters still exists. What I'm showing you in here is actually the same poll question asked globally, okay, for financial services firms, right? So it's the exact same question that we asked you to answer. And interestingly, it actually reflects some of the same findings here, where the only time, like if we ask, do you focus on RegTech only for compliance? Actually, if we're asking the global systemically important financial institutions, 0% said that they're only used for compliance. And in fact, the majority, 73%, said that it's actually considered important to operational management. Right. And some fraction of all firms, about 20% or so, say it's actually absolutely critical. So actually for the audience here, for these results for the poll that we just ran, we had more fraction of you actually say that it's absolutely critical. So I guess for many of you, you now consider that as like pretty obvious that RegTech is extremely important. Okay. But just to set the stage, let's define RegTech first. It seems fairly broad, so I'll try to narrow it down. We'll talk a little bit about how we can try to measure this also in the data. But broadly, RegTech is technology to improve the way businesses manage regulatory compliance. So from a business management perspective, we really think about these information systems as a way to improve the internal information environment of the firm. Okay, so this could be new technology. It can be upgrades to existing systems, and I'll talk to Rajeev a bit more about this later as well. It can be, hiring consultants to actually help you with part of the overhaul or digitalization process, right? We've spent the past couple decades focusing on digitalization. Now we're focusing a lot more on automation, right? And to what extent can we use things like large language models, domain specific or not, to actually help execute and automate more of these tasks. Generally, the RegTech is used in financial institutions just because we have so much financial regulations and regulatory attention, right? So we use it in reporting, risk management, capital requirements, customer protection. And so today I'll share with you some data related to the customer protection component and the broader financial service quality component. Okay, so just to set the stage, RegTech spending in 2020 was about 30 billion. Now the number is closer to 50 billion. It's growing 34% per year. That is, over 10 times larger than the amount firms spend on auditing, right? And there's a lot of financial regulation around auditing, right? And yet the use of RegTech, I think, has come really fast. And the landscape is such that, regulation keeps getting more and more complicated, right? And rarely you'll see signs of major deregulations. We might get a little bit of that in the United States, but then there are also more regulations that are scheduled to come in as well. And so, to quote this report from Deloitte, RegTech promises to disrupt the regulatory landscape by providing technologically advanced solutions to ever-increasing demands of compliance, right? And it might seem so obvious, right? Like, shouldn't we just check that, we're not funding terrorists and sending money to North Korea and so on? But it turns out when you get into the weeds of that, checking the requirements, the data can actually get fairly bad, right? And so before we're like at AI technology, we're actually at let's assemble and clean the data. So let me show you some evidence for the US financial systems. Okay, so I'll be speaking a little bit for the next 5-ish minutes about broker dealers in the United States. You can think about these as exchanges. You can think about them as financial advisors, Fidelity, Goldman Sachs, banks. Many of banks also have a broker dealer arm. The role of broker dealers in the United States is to provide financial advice as well as transaction execution services to households and institutions, right? So anytime you want to trade, you deal with a broker dealer, right? And then, the broker dealer goes and actually facilitates the flow of capital, right, from the savers over to the borrowers, who we view as household savings, and then firms using it, to like build more widgets, develop AI and whatever. Broker dealers come in two flavors. those who have custody over customer assets and those who do not have custody over customer assets, right? So for those of you who are attuned to the news, in 2022, FTX, the crypto exchange, the one that blew up, they actually had custody of client assets and just stole it, or like used the client's assets to trade on their own book, right? So that's kind of the classic case of what's not allowed, right? And in fact, this has been mandated for a very long time for regulated broker dealers. Right. And so what we do in the research here is study these broker dealers, actually study one specific rule, which I thought was super weird or kind of interesting, because what the rule said was, as of 2014, this was part of the huge Dodd-Frank Act. They said, actually, you have to segregate your client's assets at all times, right? They call it moment-to-moment compliant. Moment-to-moment compliance. And as someone who studies financial regulation and some of our work being cited by the Securities Exchange Commission and so on, this felt like a very strange rule, right? It's almost like you're saying, you can't murder, but now I'm going to change the rule, append the rule to say, yeah, not murder at any time, right? And you thought, whoa, I thought actually that would have been, the assumption already. But yet in the financial services space, many of the firms interpreted that as like end of the reporting period, right? And so you would have some flows that may or may not be compliant, but towards the end, they would actually try hard to clean up their books, right? And the financial regulation was passed in response to the collapse of Ponzi schemes, Madoff, Allen Stanford, bankruptcies of broker-dealers that took client assets with them, and the resolution, for example, of MF Global in the US was fairly involved and painful. And so this fell under, internal controls, right? And so, not that exciting of an area of regulation. Okay. So what we do is we start looking at the IT budgets, the number of laptops and servers that these companies have, the types of software that they install, the amount of hiring and the job descriptions on the kind of skills that they're looking for. We also parse out their websites to actually see, are they using any of these more sophisticated technologies to try to string your cookies and so on to see which types of clients are visiting the website and so on. And the idea of the project was to cover the entire universe of moderate-sized broker dealers, and I think we did a pretty good job of doing that. And what we found was quite interesting around this, implementation of the RegTech piece. And so I'll read you two quotes from a report by Deloitte and one from Ernst & Young after the rule change. Okay, so before the rule change, many broker dealers used systems and technology that were built in-house many years ago. These systems and reports may not have undergone periodic testing, and as a result, broker-dealers found it difficult to provide report logic details and report parameters to their auditors for testing. So new testing requirements came, the auditors show up, they said, all right, give us the reports. And the firms actually didn't have the capability to do that, right? Because the data wasn't strung up, or stored in a centralized server, or is, what we would call a single source of truth within the organization. After the amendment, you see that broker-dealers began investing in shoring up technology or data architecture to alleviate data-related concerns. And Rajeev will go into much more detail actually on how this gets implemented in practice, including rationalizing data sources, centralizing data into a single source, increasing transparency, accuracy, and completeness of the source data. What does that look like, okay, for the entire industry? It looks like this, okay? SAP, right? Enterprise Resource Planning Systems increased by about 30%. Servers increased by about 30% usage. You hired about 15% more people specifically for RegTech jobs, right? And any kind of tech-based job like coding, right? SQL, and knowing like machine learning models, Python, R, that also increased by about 10 to 15%, right? So you actually saw like this operational change among the firms during the implementation period from 2013 to 2014. And it was a fairly big jump. But interestingly, when the firms actually introduced all this data architecture, they didn't just stop there. Okay, so what ended up happening was we actually documented that they invested in complementary technologies, right? Another theme that Rajeev will also be talking about, whereby the moment you have a good data set of all your customers and assets and allocations, you can actually use that to improve your marketing, right? So projects that used to be like negative NPV, have a bad ROI, suddenly became positive NPV because the idea was, well, we have to invest in this for regulatory purposes anyways, right? So it's as if the regulation says you need to have Microsoft Excel, but let's just get PowerPoint and the rest of the Microsoft Office suite, right? This kind of idea of bundling. And then with PowerPoint, we can do more slides and pitches and webinars like this. Okay, so that seems to be going on in the data. And just to kind of close out on the net impact on the operational changes, what we saw is that complaints filed by customers related to unauthorized trading, misrepresentation, disclosure, commissions, conflicts of interest, that stuff that's like easily documented, say by recording a meeting, that stuff decreased by about 4%. And the punchline here is, the misconduct, the complaints falling by around 4.5% ish. That's about the same order of magnitude as a big financial regulation change. So like when the SEC actually comes in and implements new rules. So here, all they said was you just have to do the rules like continuously, moment to moment, right? And by investing in the technology, it seems like there's already some kind of operational improvement. So I'm about to give a couple minutes to Rajeev to kind of speak a little bit about his experience. But I think there's this interesting trend going on with the use of RegTech and the proliferation of RegTech that actually is transforming operations and compliance from processing, right, and process focus and executing tasks, actually to troubleshooting, right, and maintaining automated workflows. So I'll talk a little bit about how automation is shaping regulatory compliance and what that enables us to do in terms of increasing scale and potentially financial inclusion. And we'll also, move towards talking about the role of AI in how does that play, right? How can you AI this stuff? Well, first, you kind of need the data to be well assembled. And then we'll also talk a little bit about the trends. So at this point, Rajeev, you mind popping back up again? Thank you for your patience. I know you must be excited to add a bunch of very good points here. And also, I'll stop sharing and hand over to you for a bit.
Yeah, thanks, Ben, and glad to be here and share my experience. And more importantly, I'm excited to be here to share the future trends that are actually influencing the RegTech, right? So as technology gets better, compliance and compliance with regulations should become easier, not harder. But larger technology scenes means it also needs investment into new tech, right? So, and then that's primarily where I think both opportunity and inertia kicks in, right? So, so that is primarily how it is. And I just wanted to pick on one point, Ben, that you talked about broker dealers and custodians, etc. Right? So, generally, typically large investors separate the broker dealers or the brokers they use to access assets to the intermediaries which safekeep the asset, that is custodians. And that's how the traditional financial world works. And what makes it work is that there is a lag between trading and settlement, right? So if you trade, then you have to settle, and then there is actually a movement of asset to the broker, then who then settles with the market. And then the elongated settlement cycle makes that separation easier. Whereas in the new age digital assets, everything is instant. So, everything is instant. You can still actually have the custodian move the assets to the broker, and the broker can have visibility, and you can earmark assets in a digital wallet when you begin to trade. But there is also a way where you can basically say, oh, I just don't want to do that, and I can leave my assets with the broker. And then you basically run into these issues. And most of the best practices that the world has evolved over, I think, many decades are there for a reason, right? So, yeah, so that is what I just wanted to highlight to this audience, that it's a good practice always to keep the assets with a different intermediary or yourself, right? So not my keys, not my assets, yes, but keep it with a different. There should be separation of duties in terms of
Right.
market access and asset safekeeping.
Yeah, so you brought up a very good point there, which was the delay in the system allowed a certain industrial organization, right? You have custodians, carrying and non-carrying could be separated.
Yeah,
We view that as a good thing, right? That means you commit to not being able to use your client funds, right? Because I
yes,
don't even hold the funds.
yes,
But there's also this trend, right? Like a lot of people in the digital asset space think about, hey, why is there T plus three, right? And we moved from T plus three to T plus two, and that was huge. And then we moved from T plus two settlement to T plus one, and there's a big disruption, particularly those of us sitting in Asia. And if we trade stuff in the United States, right? I still remember joining these compliance calls with these compliance consultants, and the question the clients were asking were, does that mean we have to stay up on Saturday, right? Because we don't no longer get the T plus two.
yeah.
And their answer was yes, right? And so it seems like that can potentially disrupt the structure. So, there's a component you brought up related to the role of some of these firms. Does it seem like big companies will get bigger, right? Because that's something we saw in the research too. You put in more regulatory compliance burden, and actually the big get bigger and the medium size get squeezed out, right? So it actually may make the market slightly less competitive. So what do you think about that?
So I think, Ben, I'll touch upon that settlement point and how the broken but elongated settlement cycle helps safety of assets. One of the things is when new technology comes, you got to adopt its capability to allow for same security. Actually, digital wallets can be designed to have visibility into the underlying holdings, right? In the traditional tech, a broker can't have visibility to the underlying holdings, right? You produce periodic and batch-based reports to say, hey, this is what I had at that particular point in time. But digital wallets allow you to have real-time view of what's there in a client wallet. You don't have access, you can't move the assets, but you can have read-only access. That's possible. Then you can also earmark, or like you can create an escrow kind of facility where it says, hey, this assets I'm using to trade, funds being used to trade, and then they will be released when both client and the broker agree that to release, right? Now, that's new development, but you have to leverage it so you get the same benefit as the old system, even with instant settlement. So that is something. So new tech, when it comes in, it has to change. The big point is operational processes have to change. If you sort of don't change that and then sort of bypass and short circuit and say, hey, I'll keep the assets and I don't have access, a new entity have access, it gives, no one starts with an intention to sort of defraud customers, but then you're opening windows where that is possible. And that's primarily where I think you have to evolve operational processes to new technology capabilities. It is a lockstep thing. Yes, efficiencies are possible, instant settlement is possible, but controls are as important. And in fact, new technology makes transparent controls, implementation of transparent controls easier, not harder. But the key word there is implementation.
Right. So actually, from your kind of 2 decades of experience, what are some of the trends that you've seen? Because you mentioned, a lot of the innovations in digital wallets and so on seem very promising. Things can be transparent, and maybe instead of chasing after something bad happening ex post, we can now try to do it ex ante, right? To kind of pre-screen and have better control. And in this case, reduce even the temptation, right, for
Yeah.
financial wrongdoing. Now, what about the implications on the people doing the operations, right? So, yeah, what have you seen in terms of how your team has shifted, and the trends and so on?
So we will take the broader trend, right? How it was before, right? So again, a lot of what we do today have context in the past. And the way it all began was even before like any kind of technology existed. HSBC is sort of 160 years old in Hong Kong this year, right? And the beautiful thing about working in HSBC is you can actually look at how processes would have evolved. So when there was no technology, everything was basically maintained manually, right? So in books, registers, etc. They do exist, and if you go into the bank, you will see pictures of the old registers and how asset records were maintained, etc. And then you sort of, when technology comes through, and this is true with all tech, right? When it comes through, you try to adopt technology for what the old process is, right? Rather than basically saying, oh, this is a new capability, how do I change my process? You say, oh, how can I apply this technology to what I do? That's the default. A lot of thinking and the mindset is always about how can I basically take this new capability and apply to what am I doing, versus how should I change what I do to apply using this new technology. And yeah, it is an iterative thing, right? Eventually we will change, but first you'll apply tech to what you're doing. So broadly, what then happens is operations was at the core of whatever most institutions did, not just financial services. And you started using technology to aid operations. So a bit of, help do operations more efficiently, but not fundamentally change how you process orders or how you process execution or how you do settlement or clearing, right? They were done in the same way, and you started recording some of the data on new tech or new capabilities. And as tech gets more mature, then someone steps in and sort of says, I can do a lot more, or we can do a lot more volume and a lot more value, etc. Right? So, and I can do a lot more transaction. A classic example of that happening is lot sizes on exchanges. Ben, this is something that will be closer to research, right? So they used to be, prices were not in decimals till the late 90s in the US exchanges. The lot sizes were 100 shares, or even till recently, Singapore has, like 5 years back, I think, the lot sizes was 1,000, right? So minimum lot that you could trade on an exchange was 1,000 shares. Now, if you look at world over, most exchanges have lot sizes of 1, and prices move in decimal points, all right? So 0.01. That primarily means you can deal with a lot of volume, and that's thanks to technology. So what I'm trying to say is, operations was at the center, and then over a period as technology gets mature, technology takes the center stage and operations becomes an oversight function. Is end-to-end financial services like that? No, right? So still the back office functions are probably at the core of operations with a bit of technology, the out overlay, and they use it for largely, assisting operations versus operations being the oversight function on what technology does. That's the big transformation that we are going through, right? This is in process. If new technology capabilities come, that means tech is at the core of how operations are performed. That is, it takes more and more, and in the industry lingo, we call it as straight-through processing, low-touch activity, etc. And then technologies, increasingly, it will be used to exactly like, you said, regulatory functions like oversight, compliance, and even, continuous auditing, right? So that is, you don't take a sample and audit, you just basically look at, show me all exceptions. And if implemented right, the operations oversight function simply becomes exception management function.
Right. So actually, just to kind of frame like how big this is now. So in the security services, do you have a sense of, what's the percentage of transactions that now happen like low touch without human intervention? Because there's some that are obviously okay, some are obviously not okay, right? And then the exception handling will be kind of the gray area where it might require some intervention. Yeah.
I think largely, if you look at the industry, right? So most of trading, clearing, and settlement functions, they are largely automated. So you will basically look at upwards of 90-95%. It will differ by market as well, right? So, developed markets, OECDs will have larger straight-through processing percentages, right? So upwards of 98%, 95%. Developing and frontier markets probably a little lower, but globally we are looking at 75-80% is the minimum. But what then happens, Ben, is interesting, right? You have humongous amount of volumes, and let's say you're dealing with 30 million settlements globally. Even if 0.5% of them were non-STP, that's a huge number, right? 2% being non-STP, that is a huge number. And you begin to then fix these exceptions into systems and everything else. But in what large STP percentages do is they push up the volume, and you basically need to have enough capacity on a given day where something might go wrong. Again, it
Right.
all depends on how many systems you have in the flow, right? Let's say you have like from the exchange to like all the intermediaries and everything else. Let's say you have 40 systems, right? So this is primarily where it gets interesting. So most of the flow will be STP, but there are changes made to these systems and everything else, and one system being creating a bug on a certain type of flow on a given day is high, right? Because you have 40 systems and each of the systems go through their own change schedules and everything else. And that is primarily where I think you need to have capacity to sort of deal with things, because the business activity does not stop because you made a change in the system, right? So that's again, right, the reason why there is a lot of change control in organizations, and why a lot of testing is performed. But given how much of testing is not yet automated, there's going to be bound to be some issues. So that's primarily where I think a lot of operational capacity gets used. So
I see. So
there are
on that, actually,
activities.
could I
Yeah,
just kind of
yeah.
prod a little
Double
bit,
click on
and
that.
feel
Yes,
free
sure. Yes,
to
please.
push
Yeah,
back if it's
yeah.
not something you can chat about. But when we're talking about different types or classes of securities, do you have a sense in which, are there certain parts of the market? Is it a geography, or is it an asset class that's like more resistant to some of the adoption of these technologies?
I think one of the things is that high volume automatically forces adoption of technology. So equity trades most largely, like you can trade one share, and there are fractionals as well you can trade, and that's a market forcing function, right? So I think low value, high volume transaction is if that kind of trend sort of takes on, it's a forcing function for adoption of tech. You can't just deal with anything. So equities, because again, right? So low latency as well, right? Equities, at least trading side on the exchanges, there is certain amount of importance to latency. And high frequency trading, etc., means that equities, I would believe, public listed equities, at least I would think, that is largely a high adopter of technology and high STP rates. Now, fixed income is high value, right? So minimum bonds sizes is 250K, 200K, and you can't have a diversified portfolio unless you have a $20 million. Now, this is where it's a very interesting question, Ben, but that's primarily where it's not technology has not acted as a force function, because fixed income trades are high value, low volume. Look, even in the audience, only a few of us would basically have single name bonds in your portfolio, right? Even if you are an accredited investor, you would not want to put a full ticket of 250K or 300K. Let's say you have an investable surplus of $3 million, which is not a small amount, by the way. You would not want to put like 10% of that into a single name, right? So, and that's primarily where the inefficiencies kick in. And you go on and then look at private assets, even more, right? So even more larger tickets, etc. PE, VC, So actually, there is definitely a correlation, and I would say there is also causation there. To the larger the ticket sizes, the less prone it is for automation.
I see.
And
So
that's that.
yeah. Sorry, go ahead.
No, and that's also where you basically look at like the digital asset guys kicking in, right? So, and then saying that, oh, I will fractionalize these assets, and we can more automate some of these things more, and that's primarily there. Accessibility, I think, decreases the ticket sizes, which decreases volume, and which basically it's a good virtuous cycle. So how do you basically make more assets accessible? And as assets become more accessible, I do think volumes go up, and then that forces automation. And that's the larger macro trend that's been happening in the last 3-4 decades, right? So
All right. So on this point, maybe we can zoom in a bit on, thinking specifically about tokenization and platforms,
yeah,
right? We think of tokenization as potentially like the next phase of regulatory technology, right? The invention of Merkle
yeah,
trees was actually designed to block spam, right? Like the
yeah,
first use of blockchain as a notarization service literally was a compliance type tool, right?
yes,
Before, it kind of took on, the kind of gambling angle. And now I think we are starting to see more large scale institutional adoption by fairly heavily regulated entities around the world.
Yep.
And so how do you think the blockchain has changed the game that we've been talking about, right? Compliance, exception handling, automation, transparency. So what does that buy? And maybe you can frame it into the perspective of, how do you take a first step into entering this space, right? So you've done you've led parts of these projects, right, to actually put certain things onto the blockchain. And so what was that like? What were the resistance? Where did you get easy traction, hard traction, and so on?
I think, why was first thing I will try and address, why was I attracted to sort of blockchain, right? So why did I think it was as a compelling capability from an organization perspective? And it goes back to this whole thing where I said there are like 40 systems in the value chain. And the data has to propagate across these 40 systems. Usually this is messaging based, right? So, I send a message to another system, the other system processes a message, but then you sort of format data into messages which carry, and then you have to unpack the message, then interpret the data. So and you need control, right? How do I know the message that I sent to the other system was received correctly? So you sort of then extract data from these systems and then reconcile. And these large organizations have tens of thousands of people who are reconciling data across many different systems. Why I was attracted to blockchain was it basically propagates data automatically by design. You don't need to send messages across nodes, right? So if you're running nodes on a blockchain, and that fundamental attribute was what attracted me to this capability, right? So everything else is, data synchronizes automatically by design in a distributed ledger. And that should, because it is by design guaranteed to achieve that. So you don't need reconciliations. And that itself is a huge efficiency gain if enough participants were on chain, right? So that was one of the reasons. And then the more you sort of look at, and then I just looked at tokenization of assets as just being a smarter form of assets. So it's attributes basically you have a lot of metadata related to the asset. Today, like in the past, we all had paper certificates, and when databases came along, it was then felt that, okay, I can create electronic records of these particular assets. But all of these electronic records, Ben, were dumb, right? So it just had Ben holds 1,000 shares of Apple, right? So that's about it. It does not basically tell you what is Ben N's entitled to. And it does not tell the issuer of that particular asset what are their obligations. And when they want to satisfy some of the obligations, what does it mean? Right? So all of these dots that connect various electronic records have to be orchestrated by different intermediaries. And that's primarily where all these systems come, right? So if Apple pays some dividend, somebody has to say, okay, how many shares does Ben have? What is the dividend rate? And then calculate it and hence instruct someone else to say, hey, pay that dividend to Ben. And then the payment instruction is sent. And eventually, even if 99% of all of this is automated, there are 55,000 listed equities, I think, across the globe or something along those lines. And all of them can have tens of corporate action events. And then you're looking at significant amount of systems, value chain, and everything else. And tokenization then basically creates automated data records or smarter data records. That's what it is about. Initially, I thought of tokenization and, okay, only the asset and its meta information gets programmable, so it is efficient. But over years, over the last 6 years I've been in this space, I've come to basically, I've at least come to my own insight that not just asset information, but what blockchain allows for is tokenization of all information related to asset ownership, right? Not just the asset. And in the current world, everybody says, oh, I will tokenize an asset, but that partially delivers efficiencies. But you need to be able to tokenize all information related to asset ownership. And then smart contracts can basically orchestrate the rights and obligations across the asset life cycle. So that's primarily where I think tokenization is headed to. If you really ask me, that's 3 to 5 years away from where we are because we are still in the database world. We're not in the distributed ledger world. But I do think asset needs to come on this particular infrastructure. If US regulations basically make it easier for issuing stable coin, that would act as catalyst.
Yeah, so I think what you
We've
mentioned
covered a
reminds
lot of
me.
ground there. Yes.
Yeah, yeah. What you mentioned reminds me in the Singapore FinTech Festival this past year, I was talking to one RegTech consulting firm, and they are a data providing, and I was asking them what is their pain point and what's the use of AI, and they said, well, they deal with a lot of mid-sized banks, right, that are trying to satisfy compliance, but because of the Swift system messaging, right, they're severely limited in what data gets sent, right? And there are typos in the name sometimes, right? And so you can't trigger automatically some of these suspicious activity reports, right? Or to an ethical consideration, right? You have like a common name, right? You then suddenly raise all these flags, right? And so there's an issue that seemed like in the transaction, there's not enough metadata, right? So you highlighted this point, which is beyond just the asset itself and chopping it up into smaller blocks, right? There's like attributes and qualities. It feels almost like when Google was migrating from PageRank algorithm into GraphRag, right? Where it's like now it's a bunch more connections and relationships and attributes. So this relates to some of the questions in the Q&A as well. I thought it's kind of connects so well, I'll bring it up now. But like this kind of ethical consideration, right? And how are we implementing some of these? Where do you think those opportunities are? And as you mentioned, as you automate, people get reallocated, right? Where do the people go? And how do we make sure that the technology is kind of not kind of creating implicit biases in certain populations?
Yeah, I think availability of metadata on the network is an important thing, right, Ben? So that is something that today's networks don't do well. I believe there are financial networks today, but like what we tend to do is use this network to transmit data. The network does not, I mean, it does have some amount of validation. That is the address correct, but it does not validate a lot of data in the packet, right? It will just validate, is this coming from a legitimate source and is this going to a legitimate source? You have all these big codes and everything else. So partly it is validated, right? Source and destination information. But even though it may have information to validate the contents, it does not open up the packet. But if participants choose to, at the time of making available of data, you can validate. But even these participants don't share that kind of information. It is not readily available for them to share. And if they were to share, there will be more reconciliation functions, right? So that's primarily where they rely on their own data stores, and their data stores don't sync up automatically. So I do think if again, making the data accessible, making controls automated is a big efficiency effort, but that has to be done across participants. And every participant today is validating, but it's just that there is no synchronization between that, and that's primarily where I think modern networks, right? And DLT is a form of technology that can make it possible, but DLT today, especially the public blockchains, come with their own incentive mechanisms that are not attuned to some kind of information, right? So there is congestion tax, etc. But I do think that as we basically move ahead, again, what will improve is high usage, right? So I think we will come with, I would basically call them Web3 runtimes without the noise of Web3, which is without speculative tokens, etc. Right? So I do believe a lot of institutions will pay for costs of runtime, like they pay for costs of cloud. They would basically pay for the cost of runtime if such a runtime were made available without all the noise, and if it was basically regulated, and then the right participants were there. Again, it's akin to internet, right, Ben? Today, all of us use internet. There is, we still have privacy because, institutions can use their own VPN. Even the end users can use their own, VPNs to protect their data. So there is an amount of privacy. I do think newer types of Web3 runtimes where privacy and safety and security would be prioritized, they would come through. That's primarily where I think there are gaps today of where the supply is versus what the demand is for.
So you highlighted a key point to me, which was like coordination and synchronization, right? And
Yeah.
of course, there is no
I will
RegTech
jump
without
here.
reg.
And blockchains or distributed ledgers are actually tailor-made for multi-party workflows, where parties have to automatically sync up with the data, and then they can all do their own controls, right? But the bigger
Right,
point is a multi-party workflow where we are all guaranteed by design that we have access to same piece of information, and the systems or a distributed ledger guarantees that Ben and I have, or if you make a change, it automatically syncs and shows up on my side of things. So
right. That's right. Yeah, I still remember our conversations from 2017, 2018,
yeah,
right? When I was telling you I was so excited about data tokenization,
yeah,
right? But at that time, what was missing was who's using the data, right? And now
yeah,
with AI, right, with kind of more analysis capability, right? Maybe we're going to start to see some of this. But actually, let me pick on one thing, which was the synchronization. So how can we get kind of multiple parties to enter and start using
yeah.
this? And do you think that regulators can actually induce, right? So we saw in my research, a regulator pretty much mandated adoption, but could and then yet we have some companies starting to adopt the blockchain solutions for their internal use, maybe even without any kind of pressure from the regulator, right? But do you think there's an opportunity for financial regulation to actually switch the mindset from, say, ex post verification to ex ante screening, right?
Continuous verification, right, Ben? That's the
Right,
thing, right? So can you basically dip your temperature gauge, let's basically call it, all the time in the flow, right? So today you basically dip it once in a while, or someone basically gives you a bunch of data and then you start looking at it after the activity. But can you continuously monitor activity? So it does happen today. It's not that it doesn't happen, but it does not happen everywhere. That is basically what we are looking at, right? And how can we make it easier? So the more digitization that happens in the ecosystem, in the value chain, the more it is possible for regulators to like continuously dip and gauge the temperature and sort of view across all transactions, right? All most regulators would want is a real-time view of information flowing, and actually distributed ledgers, you can basically make that possible, right? And in any form of newer technology, even AI needs universal infrastructure, common data standards, so that they can dip in. If 30 institutions have their own data standards, then you'll basically do work on normalizing those data standards versus coming up with universal infrastructure is actually pushes the adoption of technology even more, right? And then these days we're talking about agentic AI and the agents transacting with each other. They all would need some kind of common standards so that I can
right.
make a micropayment. My agent can make a micropayment to a service, right? So I can make. It's not possible today because someone has to deal with the micro transaction, and then we don't have systems. But if you were to basically come up with these agentic interactions, yes, micro exchange of assets, value, right? So not just money, but would be made possible.
All right. This reminds me, I was reading up on Visa because I'm so excited about, how did payment networks get evolved, right, and get adoption.
Yeah,
But when Visa started, the credit card system, right, almost a quarter of the transactions were fraudulent, actually. So that's like seems like a pretty big problem. And so, I think that the numbers on the blockchain, may change over time with adoption, right? But that also echoes some of the issues I think the United States regulators are seeing, where by
yeah,
the time they freeze, a bad cryptocurrency wallet, the average balance in there is zero, right?
yeah,
Because everything is already funneled out. And so if you're not screening ex ante, the ex post check will just like never catch up,
yeah.
right? So
So
when you think
suspicious
about,
activity should not be post, right? So it is, you should, and today I think the capability exists to sort of spot suspicious activity when it is being happening.
right. So when we're thinking about, so you mentioned operational improvement, there's like an angle of
Yeah,
financial inclusion, right? That transactions or onboarding that back then may not be worth it with an
yeah,
automated system, maybe you can then
yeah,
offer this to more people. How do you think about balancing, fraud prevention versus the efficiency gains? Because, as a practitioner, it seems you're focused a lot on the efficiency gains, but then the stuff that we hear from regulators are typically on, all this online scams, right? And so on. So how are we thinking like where the benefits are? You think the fraud piece is smaller, meaning that maybe operational gains actually are like orders of magnitudes bigger? Or how are we actually thinking about that?
I do think efficiencies would also touch fraud prevention, right? So today, uh, so the issue is access is harder, so fraud does not happen because access is harder. So in a broad sense, much broader sense. But as accessibility improves, again, you have a lot more data as well, I think. And I, in my efficiency spectrum, fraud prevention also falls in that, right? So again, right, end of day, fraud is also an inefficiency in the system,
I
right?
see.
And it does add. And then I would just think that, again, right? So better fraud prevention measures do act as deterrence as well, right? Then so there is deterrence as well, right? So they wouldn't try because the system's almost, you know, we will never have near perfect, I mean, 100% perfection, but, near perfect systems would also act as deterrence, right? Continuous flow, ability to spot suspicious activity during the activity or during the flow, all of those things would act as high barriers. And then I think that's primarily what I would call as the overall efficiency gain, because then your infrastructure is going to be used largely for productive purposes.
I see. So now that we're talking about efficiency gains, right? So people used to go through these process. Now so much of it is automated. Now what do the people do? This kind of reminds me of this joke slash sad fact, right? That, I hope that AI would help to do my job and then I can paint and write poems, not have an AI write poems, and paint, and then I go do the dishes, right? You kind of are causing this kind of flip in the labor force. So to as someone who's working on implementing this and kind of getting widespread adoption, what are some things that surprise you the most about the human side of implementing these technologies, right? And kind of specifically the role of the people, right? Where do you think the labor force needs to change or adapt
Yeah,
and so?
it's interesting, right? So because when we find newer ways of doing things, humans will always be used for doing higher order things. That's basically a given thing. But let's take the example of blockchain, right? So there is this thing called smart contract auditing. And that function did not exist, right? So you do not have to have someone auditing a smart contract, and it will be audited, right? So now writing of smart contracts can be automated using AI, right? So vibe coding, and that can be done, but you still need to basically before basically agreeing to work with that particular infrastructure, you would need to basically understand what that infrastructure is doing, and then you'll have to create that, and that's a higher order thing. The higher order thing, and part of it can definitely be automated for checking on hygiene factors, but and that's primarily where I think it's an example, right, of what we will be doing when everything else is automated. You'll basically begin to look at how is it being manufactured, right, and then you will have a say in how it's being manufactured, etc. So I think we can't just imagine what new roles humans have to perform as more lower value adding works. Again, this is something that economists always have screamed that we will figure out something else to do because there is enough to do.
Right. So I think we focused fairly heavily on financial services, which is where a lot of this is starting. And then we talked about operations and compliance to a bunch of financial regulations, AML, KYC, and so on. Have you seen kind of the impact, or maybe we can speculate a little bit together on what we think the impact will be in terms of managing clients, business development, or even pushing out some of these technologies into other industries, say, booking travel, right? Buying real estate, right? That still seems like a very
Yeah.
manual process. There's a lot of notarization involved. There's big amounts of money involved. Hotel bookings, right? You show up with the passport, right? You can switch, all this stuff. Kind of, where do you envision this stuff going? Is there a kind of universal wallet? And does this ride on the trend of like the financialization of everything? And what do you think will happen over the next kind of 5 years or so?
I think newer forms of, I mean, there will be a merging of capabilities, right? Again, the fact is that not single technology, but a combination of technologies actually changes the way we behave, right? And it sort of drives the change. One should be newer revenue opportunities should be coming through, right? So, and that's primarily where you have identity is a big place where I think verifiable credentials that are temporary as well will. I don't need to expose my the entire personal data because I'm simply checking in a hotel. They would want to know I am a legitimate person. They would like to know which country I am from and how can they reach me if something would demand that. And then that's the only data. They would not. They shouldn't be knowing. They should be knowing if I'm an adult, not when I was born, right? So there should be a verifiable credential that says yes, he's an adult. He's above 18. He's 21, whatever. He's according to that particular jurisdiction, but not what's my date of birth, right? So that's unnecessary. I do think we will be headed down that way from an identity perspective. And I also think that we will have new infrastructure which will give us, the users, a lot more agency in terms of what we would like to expose to a party. So the interaction should happen, right, between me and a business. But I would like to determine what is the kind of data I would want to expose to that particular business.
Right.
Today, we expose everything, right? So there is no granular decision making, and we already have seen that in Singapore, right? So when we go to my info is an example of you can choose what to expose and what not to expose, but I think that one should be broad based, right? So today only a few firms in the ecosystem get, and then zero knowledge proof, which is primarily an area of a lot of interest in the identity space and verifiable credential space. Again, right, adoption of that, newer concepts like FinTech, we've been speaking about it, where they talk about single rails for multiple assets, everything. And I'd like the audience to go out and find that out. Again, that is compliant by design. Ability to sort of continuously monitor all activity if you have the right permissions. Those kind of things will probably shape how much larger financialization would happen for assets, right? So more and more digital representation of ownership, even of physical assets, would come through because ultimately you know exactly where your house is. It's just that there is a register that is basically largely manual that caters to this. But if that kind of thing, if you are able to tokenize that information and make it freely available on demand or easily available on demand with the right parties, then we can transact, right? I can transfer the rights to part full of a hard asset. And yeah, again, you would get new roles there where somebody has to safekeep that particular physical asset. And that would be the new business opportunities, I think. But yeah, greater financialization of assets is a given.
Yeah, I see. So then, but with that, the hope is also we have greater compliance broadly, right?
Yeah,
Identity
exactly, right? So newer
related to
types
the.
of compliance rules, right? So when you basically begin to financialize, you will need new regulations. You would need new compliance technology to ensure that you're compliant with the regulations. And they go hand in hand.
All right. So as we're wrapping up, it reminds me, not that long ago, someone stole one of my physical credit cards. And, after back and forth with the bank, one of the bank mediators came and told me, sir, a credit card is just like cash. And my response to them was, with all due respect, I really hope it's not, right? I hope it's way better, right? You can have better security, right? And so, we're going to push, a lot of responsibility to the user. So in this last minute, when we're thinking about, potential breakthroughs, right? Kind of more better ownership, more potential economic activity, what would be the space you would recommend us to kind of keep an eye out, where maybe it feels like something may come out of left field and even disrupt multiple industries? So much broader than just, banking or equities trading, security settlement, where we started, right? So we started in these narrow use cases, and we're now ending towards this broader picture. So what would be the types of work that you'll be advising us to keep an eye out for?
So I do think like let's take I think in our lifetimes, and I assume everyone's between 20 and 50 in this audience, right? What has significantly impacted us is internet. Internet was a network of information, right? Network of content, and it has completely changed how we live our life. And I do think the next 20 odd years would be probably networks of value. That's what we need to sort of focus on, right? So internet changed the way the economies function because they were able to enable seamless exchange of data, right? Then information, and then firms that are native to internet like Google, Meta, the top 7 companies have basically ridden on the internet rails to get their valuation today. I think the future, and this again left field, is keep an eye out for networks transforming into networks of value, which basically make value exchange easier, and that probably would give rise to another set of giants, right? Or maybe not. Maybe there will be a lot of smaller size firms that specialize in, and then it's no longer going to be a winner takes all. Right? I don't know. We don't have the crystal ball, but that combined with, I think, artificial intelligence is the way it is shaping up. There will be a lot of speculation, Ben, and I definitely believe that speculation helps to install capacity, right? Technology, resources, skilled labor, everything else, and the bubble will burst, and then suddenly all that capacity, the cost of using that will come down, and that leads to adoption. This is a cycle, right? So this is a cycle, and then I do think networks of value combining with artificial intelligence is what may define how economies and societies function for the next 10, 20 years. But we are in a time and space where there is continuous accelerated change, I think.
Great. Yeah, I think that ends on a quite promising note. So thank you, Rajeev, for joining us today.
Thank you, Ben.
And we'll end the webinar now. Thank you, everyone, for joining and staying 2 minutes extra. We appreciate your time.